let's move on to talk about Bollinger Bands. Now, Bollinger Bands is a very, very interesting indicator. It's one of the few indicators that actually gets dropped on your charts over top of price instead of underneath. It was created by John Bollinger. Now, when Bollinger developed these, they were really developed, I mean, it isn't so long ago, but it's like 30 years ago, for the stock markets. Remember, there wasn't online trading. The markets moved a lot slower. But fortunately for all of us, John Bollinger is still with us and still very active and still operates the Bollinger Bands website. So you can go at your convenience to www.bollingerbands.com and learn directly from the horse's mouth. But as online trading became popular, as Forex trading and CFDs became popular, as the market started moving lots and lots faster, as Forex became popular, it was quick that we learned that Bollinger Bands quickly adapted to fast-pacing, fast-moving markets and work well in financial markets, including equities, Forex, commodities, futures, and work great in short-term periods, to hourly periods, to weekly or monthly periods. Bollinger Bands adjusts and works quickly in all markets. Now, Bollinger Bands answers a very simple question. There's a question most of you won't ask yourself, but you should be. And that is, are the prices high or low on a relative basis? In other words, we know, I don't know where the euro is trading today, but it's been trading around parity, about $1. Well, you know right now that's a very low price for the euro. Okay. So on a relative basis, we know that the euro is extremely low. We know the pressure to push the euro lower could be high, but it would be easier to move back up in the markets only because it's so low. So on a relative basis, we want to know, even though, say, Microsoft has climbed steadily, is it in a relatively high or low point overall for Microsoft? Now, by definition, the price is higher at the upper band and price is lower at the lower band. This bit of information is incredibly valuable. It's even more powerful if combined with other tools, such as other indicators for confirmation. Okay, so I gave you a lot of words. Let's go look at a chart so you understand what we're talking about here. Now we're looking at the Euro US dollar chart. And we're looking at a 1 hour chart only because this is my teaching chart. It's the only reason. I use this standard chart for teaching every class. Now, all the dashes and dots and stuff going across your screen are my support and resistance levels. These are mine, okay? These are my own keys as to how new or how old they are, how important they are. Okay? And I never trade any asset that I don't have my support and resistance levels on. But Bollinger Bands starts out on using a 20-period moving average. And that's the orange line that I've dropped on the charts. Simple moving average. And it's called the basis line for Bollinger Bands. Bollinger Bands then takes a statistical calculation known as standard deviation. And we're going to get on to standard deviation in a few minutes because you have to kind of understand what it is. You don't have to calculate it. But standard deviation is a statistical measure that's quite unique and quite important because it actually, when you understand what it is, it gives you some important market information. Now, Bollinger Bands uses what we call a 2-time standard deviation, and it gives us a calculation above and below the moving average, plus 2 standard deviations and minus 2 standard deviations. And this gives us the bands that form the Bollinger Band, called the upper and the lower band. So these blue lines that you see on your screen are the upper and the lower band. And you can see each one of these is above or below that moving average. The lines below the lower band is minus 2 standard deviations, and the line above is plus 2 standard deviations. Now, the shape that the Bollinger Band makes is relatively unimportant. Sometimes they look like snakes. Sometimes they look like aliens. They can look like all kinds of, they don't really tell us anything, because Bollinger Bands is not about the shape of the bands. Now, the width of the bands is very, very important and tells us a lot about the market. The wider the bands are, the top to the bottom, the more volatile the market is. Because you can see here, price is moving down, but the bandwidth between here and here stays relatively the same. So even though price is moving down, the market's not volatile. Here we had a very harsh decline and the market climbed volatility. Now, volatility is an important thing that you need to know, because volatility helps you decide how far or how close you can put your stop loss, because the higher the volatility in the market, the farther away you need to place your stop loss, because the swings are in the market. So like here, we can see the market is very volatile. Here, and this is what you can see quite often, is the market's non-volatile pulled into contraction, and just, this is how the markets are, just sideways congestion most of the time. Now, I know you thought I wasn't going to go back to the statistical calculation, but we can't learn Bollinger Bands without it. So let's go back to my PowerPoint. So a Bollinger Band consists of a middle band, which is the moving average, and the upper and the lower band. The general principle is that by comparing a security's position relative to the bands, a trader may be able to determine if the asset price is relatively low or relatively high. Further, the width of the bands can be an indicator of the volatility. Narrower bands indicate less volatility, while wider bands indicate higher volatility. So the Bollinger Band starts out with the 20-period moving average. Now, some traders may make up those periods. Some traders may want to use a 30 or a 40. You can adjust Bollinger Bands to anything you want. But the standard Bollinger Band uses 20 periods. Once you adjust it from the 20-period moving average, you then have to also adjust all of your response. Now, in addition, the default is that the upper and the lower bands are set at 2 standard deviations above and below the price. However, it doesn't have to be 20 periods. It should be noted that many traders will decrease the standard deviation when charting less than 20 periods, or increase the deviation when charting more than 20 periods. You can change it all you want, but then it goes from Bollinger Bands to Barry's bands. And then Barry has to do all of his testing and see how it works. Now, standard deviation. We won't spend much time, and I'm going to try to make it as painless as possible. Because interestingly, in the real world, no statistician would ever calculate standard deviation by hand. The calculations involved are somewhat complex, and the risk of making a mistake is high. Also, it's very, very, very slow. Now, standard deviation is a measure of a dispersion of a set of data from its mean. Okay, you lost already? Now, I have an undergraduate degree in mathematics. I can figure it out, but it still takes me a little bit of time. It is calculated as the square root of variance by determining the variation between each data point relative to the mean. If the data points are further from the mean, there's a higher deviation within the data set. Okay. Now, let's say it so that you can understand it. Or let's say it how it has to do with us. So I'm going to use the same definition. Standard deviation is a measure of the difference between the open, the high, the low, and the close, and its moving average for the same period. So if we imagine that if we were to take an open, a high, a low, and a close, and measure the distance between each of these and come to the dispersion, and then figure out where the moving average would be, the more that the price is divergent from its average, tells us the farther apart these are. So the farther the open is from the close, or the high is from the low, is a relatively important thing, because when we look at a candlestick, what do we want to look at? The wicks and the body. We want to see how long that price moved, how big the wicks, the upper wick is, the lower wick, the open, and the close. So what are we then doing? We're comparing that to a moving average. But that's the initial data we're starting with. It is calculated as the square root of variance by determining the variation between each data point relative to the mean. So in other words, it takes each data point, or the open, the high, the low, and the close, and does this calculation to figure out how far it is from the moving average. If the data points are farther from the moving average, there's a higher deviation within that data set. Okay, got it? So what is it doing? Standard deviation is giving us the comparison of the high, the difference, or the between the open, the high, the low, and the close, and the moving average, which is a very important piece of information to have. So in its simplest form, the mean is simply the average of all data points in a given set. In investing, for example, you might want to know the mean closing price for the last 20 days or 20 periods. And what's that? It's a 20-period moving average. This can be obtained by adding the closing price for the last 20 sessions. Now, by default, and I don't know how Bollinger decided to use two standard deviation, but he did a lot of testing. But that is simply what we use to drop this band onto our trading. Because now that we have it there, we have to figure out what we do with it. So remember, as I said, the width of the bands gives you one piece of information, the volatility. The other information, or what I have the blue background here, is relatively unimportant. And what does become important is the moving average and the upper and the lower band. So for right now, I'm going to take the background off. I was going to change these colors of the upper and lower bands to horrible blues. There we go. Okay, now the moving average isn't there only for a calculation for standard deviation. The moving average in interpreting or using Bollinger Band is critically important. But you have to be able to look at what price is doing. So for instance, this is what we call riding the band. as price is moving down and is steadily pushing to the bands. At some point, price is rejected by that band. In other words, it's riding down right on the bands. All of a sudden, at this point, it can no longer reach out to those bands, and it kind of gets pushed up. That tells us that that trend or that movement is in trouble, but it's not ending. It's not over. It's not telling you anything at all. Once price is rejected, but if it stays below the moving average in this case, it's still on point. It is crossing and breaking that moving average that tells you that downtrend is now officially over. Doesn't tell you it's moving to an uptrend, but that downtrend is officially over. Okay. And you can't, it's a very subjective decision. Not the crossing of the moving averages. It's what do we call rejection from the band. It is not, it's got nothing to do with breaking the band. It has to do with price moving up and pushing to that band. And in this case, like pushing slightly above it. But the fact is above it, it's when it can no longer reach that band. So here we can see right here what happened. Price couldn't reach that band, got rejected, but stayed above that moving average and look and continued. It did turn it an uptrend. It tried again. And then it failed and finally broke that moving average. Now, when price is moving sideways, it doesn't really help you so much. But look, as price is moving up here, if we had been in the market in a buy scenario for some reason, and we saw this occurring, and we saw the rejection of the band, we might want to get out of the trade we were in. Doesn't tell us that trade is over, but it's telling us that upward movement is now in trouble. Here, it then broke the band when it came all the way down, and then went back above and started riding back up and riding this band, but here it always stayed above the moving average. So the moving average becomes critically important when trying to interpret the bands. Okay, let me get my PowerPoint back up here. Okay, now, there are 3 different ways that we can use the bands. Okay, one is pattern recognition. This is an old, outdated use of the bands. The bands make, and if you're trading a very slow market, or you're looking to invest in something, or you're looking to do a longer term swing trade, bands will form what we call an M and a W. And these M and Ws are fairly reliable. They take a very long time to take place. But when these M and Ws are formed, this pattern recognition will give you a good opportunity. It also gives us reversal signals. It helps us identify early signs of reversals. And lastly, it gives us trend analysis, will help detect continuations or the conclusion of a trend. Now, prices can walk the band during a strong downtrend or uptrend. This means that they are repeated instances of the price touching or breaking through the lower or the upper band. That's why you may not want to take action when the price touches either band, and might instead prefer to wait for a double bottom or a classic M top or a 3-push higher confirmation. There are simple strategies and more complicated strategies. But as I said, what we want to look for, and whether you look for it for 2 or 3, we want to look for rejection of the band. Rejection of the band doesn't happen in it's not one time frame. It's actually be 2 or 3 or more time frames that the price is rejected. So your price is moving down, it gets rejected. Price is moving down, 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 down. And then what happens is it is rejected. Okay. But just a simple rejection doesn't tell us anything. Okay. And as long as it doesn't move above the moving average, so what did we get? We got an early warning sign that this trend is in trouble. And we might have gotten an early warning sign or a sign to exit the market. Now, the M and the W patterns form over a long time. It's like watching, I don't trade from head and shoulders. It's like trying to watch a head and shoulders pattern develop. We trade in very fast paced markets. What'll happen is price will move down the band, will hit a bottom. It will come up, break the moving average, form a top, get rejected again, and form bottom. You wouldn't even know anything was possibly developing at this point. At this point, we have what is called the N. This N pattern is a precursor for the W pattern. When we have price then bounce off an equal level bottom and start moving back up, we then, at the break of the moving average, know that we've got a full reversal and a moving 10 uptrend. But that's, I mean, look how many time periods it took to form that. Okay. It is reliable, but in most cases, if I ever see them, I see them when they're long over. And we have the bullish and the bearish, the M and the N. They're just mirror images of each other. Now, Bollinger Bands is not lacking, is not the right word. Bollinger Bands doesn't tell us to enter the markets. It doesn't give us stop losses. It doesn't give us target points. And it doesn't tell us whether we're going to get a good buy or a good sell. It's only an indicator giving us information. So it works well, for instance, with RSI, because RSI will confirm the overbought and the oversold situation and can help you actually determine what to do. So walking the bands is probably the most popular way of using moving average, the way that I use it. But Bollinger Bands can also indicate the ends of strong trends. Strong trends cause an expansion in volatility that will cause the band to initially move apart, meaning the lower band will move down opposite the trend. When a trend begins to wane, the lower band in the uptrend will turn back up, which can then be a signal that the move might be over. Because volatility tends to be mean reverting. Periods of low volatility are generally followed by high volatility and vice versa. And this gives us a very easy trading opportunity that's known as the Bollinger Band squeeze. It's almost the same as watching a triangle. As price moves into the apex of a triangle, we know that as price gets pushed farther and farther in the apex of a triangle, it's going to break out. We don't know whether it's going to break up or down, but we know the breakout is getting closer and closer. So when the bands are narrow, it's called a squeeze. And it means that volatility is very, very low. And we know volatility, when volatility stays low, sooner or later, it's going to jump out. Sooner or later, something's going to be initiated. But remember, since volatility is mean reverting, the bands will probably expand. When the bands start to expand after a long period of being in a very narrow, low volatility, it usually breaks out with a very large potential explosive move. A simple way to spot the squeeze is when the bands are the narrowest or have been for a while. Now, bands also help signal the start or the end of trends. So as you can see, Bollinger Bands can be a very useful tool themselves. But remember, too, that they can be combined with other indicators. Since they are a pure price indicator, you might want to consider combining them with volume indicators for even more in-depth and insight. Ultimately, there's no indicator that guarantees you get in at the bottom or out at the top. However, Bollinger Bands, especially when paired with other indicators, such as chart pattern recognition tools, can help you make better trading decisions. There is a preciseness using Bollinger Bands. Use this preciseness to your advantage. The Bollinger Bands is a great indicator to use in any market. When you combine these with RSI, it should give you a great entry points. Something you consider when the price touches the middle band, you can make, okay, when you're trading at Forex, when price touches the middle band, you can enter a second trade and press your winners to keep on going. With this strategy, we only use one trade that we initially make. But if your rules allow you to make multiple trades at a time with the same currency pair, then adding a second position at the middle line may be something you would want to consider. So Bollinger Band is a great little indicator. Like I said, it doesn't give you entry points. It doesn't give you exit points. It gives you pieces of information, clues that are very important: volatility, the strength or weakness of a trend, and when a reversal is taking place. So try out Bollinger Bands, put them on your charts. They're very simple. Any charting system already has them set up. Just click on the Bollinger Band. It'll drop it on with the 20-period moving average and a 2-period standard deviation, and go for it. Try it out, test it, watch it, because the only way you're going to get to be an expert with Bollinger Bands is to practice it, because what is critically important is not this, not this, not this, because the only thing you can trade is here. But what is this telling us? What are we seeing right here? Practicing with it, all of a sudden we see a widening of the bands. Now, even though price has been moving in a steady uptrend, and it fell all the way down here, but we also got a very widening of the bands. But we're riding down that band out here. It's telling us something, because we can see that volatility is steadily increasing. But look how beautifully it's riding that band. When it broke the moving average here, we had a beautiful current trade that we could have made. Okay, so practice, practice, practice. Add it into your trading system, and before you know it, you'll be incorporating Bollinger Bands in your everyday trading. So thank you for joining us. Have a great trading week, and thank you for being part of Albexo. Bye now.